Financial Accounting, Chapter 8, Receivables, Part 1 of 3. Let's do our traditional recap as we start a new chapter, and that is that we've learned how the financial statements are prepared and what they're used for. We've learned how they relate, what information they provide for their users. We've learned about how transactions affect these financial statements. We have talked extensively about classified financial statements, about inventory, and in Chapter 7 we talked about cash transactions and the bank reconciliation and internal controls and how all of these things affect our financial statements. Chapter 8 is about receivables, money owed to the company by different customers or individuals that maybe they've loaned money to if they're a bank. And so these receivables are current assets, and we're going to be going through in detail the accounting for receivables and what we do if we can't collect our receivables. We're going to be splitting this chapter up into 3 parts. The first and the third part are more conceptual. The second part is going to be where we really dig into the different methods of accounting for uncollectible receivables. So receivables are accounts receivable. Sometimes they're known as trade receivables. That's generally money owed by the customers to the business. Notes receivable, financing receivable, interest receivable, they're different types of receivables. Again, they're all assets depending on when they're expected to be collected. They can be a current asset if it's a collection that's expected within a year or less, or it can be a long-term asset if it's a receivable that's expected to be collected in greater than a year. And again, these classifications of current and long-term help users of the financial statements. Accounts receivable normally have a short-term period. So think back to the chapter where we talked about a sale having terms, 210 net 30, meaning that a customer would receive a 2% discount if they paid within 10 days, but that the net amount, the entire amount, is due in 30 days. Sometimes receivables are collected within 60 days. And it's important that a business follows industry trends, so it wouldn't be wise for business to tell their customers that they have to pay within 30 days when their major competition is allowing 60 days for payment. All of these things work with cash flow, and the faster a company can turn their receivables into cash, the better off they are. But these accounts receivable are almost always considered a current asset on a classified balance sheet. Notes receivable are similar to accounts receivable but are formal. They usually have a written paperwork, sort of like a contract. That's why it's called a written debt instrument. And it's usually current, or it can be non-current if it's going to be collected in greater than a year. The one below is tremendously old school, but it does show the details. And the reason I say old school is that people don't really sign these anymore. But this is an example of a $10,000 notes receivable from a customer at the bottom, shown as Justin, it looks like, Payne, to Kimsey Medical Clinic of a promise to pay the $10,000 with an interest rate of 12%. So generally a notes receivable is going to have terms. When is it due? What interest rate is going to be in there? And lots of times these come about from maybe an accounts receivable that was not collected. So let's say you own a landscaping company and you find that one of your customers is 60 days past due when the bill was supposed to be paid in 30 days. You might reach out and say, I'd like for you to sign a note and I'd like you to make payments. And they may pay the full amount within 6 months, or maybe they'll pay a portion of it each month or each week. It all depends on the terms of the written debt instrument. Uncollected receivables are our biggest problem. Uncollectible receivables means that the customer's not paying, and that can be evidenced by anything from bankruptcy to failure to receive any communication from the customer. Sometimes it's whenever the company is doing poorly. Sometimes the company has actually lost the bill that they received, and oftentimes they're playing games with their cash flow. And I really do mean playing games with their cash flow. It has been well noted that some major corporations are so big that they don't pay their bills on time because they know that their vendors can't afford to lose them as a customer. So sometimes companies will sell their receivables, and when they do so, it's called factoring their receivables. Less than 100% is received, and of course that's not a good thing, but there are factoring companies out there. Sometimes a bank will factor a receivable. So it would work like this. Let's say that you own a business and you have a customer that owes you $10,000 and you're in need of cash, and you could pay all your bills if your customer would pay the $10,000 owed to you, but that customer is not coming forward. So you can factor your receivable by going to a factoring company and saying, hey, I've got $10,000 owed to me by this customer. How much will you give me for it? And then the collection is in the hands of the factoring company. You'll probably receive 80 or 90% of what that was owed to you. You might not receive but $8,000 out of the $10,000 owed, but at least you've gotten some cash. There are factoring scenarios with recourse and without recourse, and those are studied in upper level courses in accounting. The accounts receivable that are uncollectible, bad debt expense, uncollectible accounts expense, doubtful account expense. All three of these are terms that are used by the corporate world to show that we just finally gave up. We couldn't collect this person. They either went for bankruptcy, filed for bankruptcy, or they closed the business down, or they're going through such financial struggles that we don't think we're going to collect anything. And so this is the challenge of Chapter 8, and that is dealing with uncollectible receivables. Again, these three terms, important that you know what they mean, and they're all expenses. And it doesn't matter which term is used. Different companies use different terms. We're going to find that a business can either wait until the account is determined to be worthless. That means we know we're not going to collect anything. And they record the bad debt expense then, and they just remove the accounts receivable from their assets entirely and record an expense. Alternately, and this is required by GAAP, and it's extremely important that this be the method that you use the most because it's required by GAAP. They require an allowance method. So an allowance method means you have to estimate how much you think you're not going to collect out of your current accounts receivable. This is because of the matching principle, which says expenses have to be matched with the revenue that they go along with. And one of the expenses of doing business is that you're not going to collect all of your accounts receivable. So anybody that goes into business thinking they're going to collect 100% of the money owed to them is probably not going to find that to come true, because most of the time your customers are going to stiff you, as they call it. So the allowance method says that the business has to estimate the uncollectible accounts, the bad debts, the doubtful accounts. They have to do an estimate. And this is required by companies that have large amounts of receivables, and they have to use this method. And that's going to... So let's take the easier one for this part first, and let's look at how it's recorded. So if we use the direct write-off method and make an assumption that an account receivable from a customer is determined to be 100% uncollectible, then we will record a bad debt expense that will match with the revenue during this period, and we will just take this customer's accounts receivable off of our accounting records. It's no longer an asset. Debit bad debt expense, credit accounts receivable to show that 100% of this receivable is uncollectible. Again, this direct write-off method is only allowed for companies that are small and have very few accounts receivable. I want us to try one. I want you to try one. And this worksheet has two entries that are required for the direct write-off method. And so take a quick minute, maybe put these 3 T accounts, these are already labeled T accounts, on a piece of paper and see if you can work this problem. So we've got accounts receivable and revenue. And the first transaction says, Smith Company sells $100,000 during the year, all on account. So that means you're going to have to record the increase in the accounts receivable and the increase in sales. Best practices would mean that you're writing this down with pencil and paper and recording this transaction. And the answer is, if you want to pause before I tell you the answer. Okay, the answer is that you debit accounts receivable as an asset for $100,000 on the left-hand side of the T, and you credit sales or revenue on the right-hand side as a credit to show that revenue has been increased. And hopefully at this stage in Chapter 8, you're automatically thinking accounts receivable is an asset, sales are part of our revenue that go on the income statement, and they ultimately increase retained earnings, which ultimately increases stockholders' equity, and this is increased by a credit. And once you find yourself automatically going through that process as you're doing these transactions, you'll be much more open to learning more about different transactions in future chapters. Okay, so let's move on to the second transaction. And before we finish this part 1, they use the direct write-off method, and they find that one customer who's filed for bankruptcy is never going to pay the $15,000, so they write it off. And I'm sure you've probably heard of being written off before, so that's literally what it means. Let's take it off of our accounts receivable, and we're going to record the uncollectible account down here. Uncollectible accounts expense, it might be called bad debts expense, it might be called doubtful accounts expense. So take a minute, pause this recording, show where this $15,000 transaction is going to go. And the answer goes here, the $15,000 expense and the $15,000 reduction in accounts receivable. So now our accounts receivable shows that we've only got $85,000 because we're not going to collect this amount from this one customer. It shows that we have revenue here, and one of our expenses is a $15,000 uncollectible account. This concludes part 1. I did want to throw a comment out there in case you see these random highlight marks on the page. It's because the mouse doesn't always show me where it's located when we're doing these narrated PowerPoints. But I would appreciate any feedback that you can provide as to whether these narrated PowerPoints are helpful and what I can do to improve them in the future. This concludes part 1 of 3, a foundation, before we get to a further and more detailed discussion of the allowance method.